So the one constant in venture is that it's always changing, right? There's always LPs that say, I've got a denominator effect issue. There's always times in the cycle when the big brand name firms are raising all the money and the emerging managers don't get any attention. And then so there's always been these ebbs and flows.
At Context Ventures, our podcast, Advancing VC, covers all things startup and venture capital, primarily how venture capital is changing from the emerging manager perspective. We'll be talking with venture capitalists, limited partners, and founders who are actively working at the frontiers of our industry and are advancing venture capital. I'm excited to welcome our guest, Courtney McCrea, the co-founder and managing partner of Recast Capital. Courtney has 2 decades of venture capital and private equity experience. Thank you, Courtney, for joining us.
Thank you for having me, Tim.
Awesome. Courtney, I'd love for you to share your journey to becoming the co-founder and managing partner of Recast Capital. As I mentioned, you've got 2 decades of PE and venture capital experience, and so would like to hear about that experience.
No, happy to. So I've essentially been in the private equity industry my entire career. And when I started, I was a Kauffman Fellow, one of the very early Kauffman Fellow classes. And back then, the Kauffman Foundation actually paid my salary. And they understood that it was an apprenticeship business. And so I was partnered with a growth equity fund. And at that time, the number of women in venture and in growth equity, you could count on one hand, and maybe it would go to the second hand. It was very few, and even less that were actually in senior positions. I was at Weston Presidio for 7 years, joined as a principal in the middle of Fund 1, and then was promoted to general partner in Fund 4. And that's actually what brought me out here to San Francisco. At that point, I made the move over to the limited partner side, and most relevantly, for 10 years, I was one of 3 managing directors on the investment side of the house at a boutique venture capital fund of funds called WeatherGauge. And at WeatherGauge, we invested with brand name funds, but we always had an open door for new names. We were always just looking for those managers that we thought had the potential to generate a 3x plus. And not that you always get a 3x plus, but at least they have the potential to get to that level. And so I was there for 10 years with my partners, invested in exactly 100 venture funds, a little over $1 billion in commitments. And when it came time to raise the next fund, my other 2 investment partners were a bit more advanced in their career, and they decided they didn't want to raise another fund. Instead, they're being good fiduciaries to both our general partners and our limited partners, and they're managing out the portfolio. A pretty sweet retirement plan, if you ask me. But that wasn't what I wanted to do. And so with their blessing, I put my head up and started to reconnect with those in my network. But I was passionate that it is not, nor has it been, a stagnant list of 10 venture funds you needed to have exposure to or don't bother. It has always been an ever-changing landscape of the top best funds. And if you look, finally Cambridge came out with quantitative data that backed up what we had already always known sort of anecdotally, which is consistently the top 10 best performing venture funds in any vintage year. A disproportionate percentage are institutional funds 1, 2, 3, or 4. And it's just logical. It's at that stage, you're raising right-sized funds. No one's getting wealthy off of management fees. And if you are not a good picker of companies, you're eventually going to have to go back and find another job and go back to what you did previously. And venture capital properly done is a really fun and can be a very lucrative career. And so you'll never find scrappier, hungrier, more well-networked with the investors that do back them than emerging managers in venture. And it's not to say that every emerging manager is going to outperform, but properly selected emerging managers do outperform consistently. And so I found a like-minded limited partner in my now co-founder, Sarah Zulkowski. She had been at the Clark family office doing direct and fund investments, then went over to Greenspring Associates, and she saw firsthand the same thing that I was seeing. And so it was another limited partner who said, the 2 of you should have a real conversation. I never thought she would be loose in the saddle, and she was. And so we launched Recast back in 2020, right before COVID, and we're off to the races. And we decided we were going to focus exclusively on both investing in and supporting emerging managers in venture, institutional funds one, two, or three. And then we do have a preference for diverse partnerships. We fundamentally believe the data that has been out there for decades, that more diverse senior partnerships end up making better decisions. And in addition, venture capital is and has been for some time highly competitive. And to the extent that you have different networks, different live life experience, or you just see the world in a way that other people don't see the world, it's going to drive outperformance. So Recast Capital is a platform to both invest in and be supportive of emerging managers in venture. We have three parts of our business. We have our fund of funds that actually invests in emerging managers in venture. We have a tuition-free educational program that we've been running for 4 years. And then we have a fiscally sponsored nonprofit with the initial support of Pivotal Ventures that is supporting, over the course of 3 years, 90 female-led and non-binary-led venture capital funds. We provide them with our educational programming all around how to make your fundraising process more effective, more efficient, and maybe more enjoyable. But we also, for those 90 female non-binary led funds, we are also paying $100,000 of their operating expenses. It takes women and people of color 2 to 3 times longer than their white male counterparts to raise their funds. And the goal of this initiative was to try and keep these individuals in the market longer, to be able to be more successful in their fundraising journey. Many of these managers also don't come with deep pockets themselves, don't have friends and family that have deep pockets. And so this capital also allows them to perhaps have a level playing field with those that do have those resources at their disposal.
So much to unpack there. And so many questions. So I'm going to go from tactical to more strategic. First is Western Presidio. Was it named because it was based in the Presidio, San Francisco?
So it was Weston Presidio. And so the Weston was Weston, Massachusetts. There was one of the founding partners was based in Boston. And then Presidio was the Presidio because the other general partner lived somewhere near the Presidio. And it now is called Main Post Partners. So the next generation has taken it over and rebranded it.
Check. And then you said 100 venture funds. Was that like 10 venture firms with 10 of their funds, or is it like 50 venture firms, 2 of their funds? Like how would you classify that?
So I'd have to go back and look at that, but I would say that it's probably 25 to 30 firms.
Got it. Greenspring. My understanding is Greenspring was a fund of funds that was acquired.
It was, yes, by Stepstone.
What I find fascinating as an emerging manager is that the same dynamics that happen for companies can also happen for LPs. Diverse. How do you all define diverse?
So we at Recast define diverse as diverse relative to the existing venture capital ecosystem, which is very not diverse. So we have a very broad definition of diversity. It encompasses gender, ethnicity. It also could be, veterans. It could be differently abled individuals. It could be indigenous people. So it's a very broad definition of diverse. The work that we're doing with Pivotal Ventures and with our fiscally sponsored nonprofit is female and non-binary, because that is what is true north for Pivotal and for that organization.
Understood. Back in 2013 or 2014, when I was in business school, I wrote a case study on women in venture capital, and it was like less than 1% of partners were women in venture capital firms. And when I had to go find women VCs to interview, it was very difficult. I ended up interviewing Patricia Nakash at Trinity, Rebecca at Morgan Thaler and Canvas. But there were so few back then. I feel like it's slightly improved, but I feel like I'm curious on your take on women in venture. Like it feels there's so much more room for improvement.
Absolutely. So even when you were listing off those women, going back 10 years, it was probably four names, maybe five. And so one of the goals of this fiscally sponsored nonprofit was to double the number of female venture capitalists in 3 years. The good news is a year and a half in, that has already happened, not just because of our program, but for lots of other reasons. And but the issue is that demographic is woefully undercapitalized. Their AUMs are not what they should be for what they need to accomplish. And so as a result of that, we've sort of with the approval of Pivotal Ventures and our advisory board, we have actually pivoted what we're doing next year and a little bit what we're doing this year, where we are providing more shared services, trying to make these do what we can to make these managers even more successful in bringing on assets, even more successful in telling their story and getting LPs to invest in their fund. So we'll see.
Another quite tactical question is that 100K of capital to help these new managers. Having raised and closed a fund, I know how expensive it can be.
Yes, it is.
It is legal fees for all the closes, fund admin, auditing, K1 taxes. It just adds up. And so that 100K is a lot of capital to help a new fund. That can really help a new fund.
Yes. So, it all depends. I mean, it's funny. We went back and looked last year. We had 36 funds that we worked with, and we looked at how they spent the $100,000. And it was all the things you mentioned. But in addition, there were firms that decided that they wanted to be able to make their organization more institutional than it otherwise could be. And so they'd use it for PR, or they would use it for a back-end operations support, or they'd use it for an intern or an executive assistant. So there were lots of different ways that they chose to use it, and it really speaks to how different every firm is and what their needs are.
For sure. And that capital can, it sounds like, be used to go to conferences to raise additional capital, because so much of that fundraising and closing a fund is having to go meet potential LPs.
It is, yes. And so, we are actually paying all the bills for them. So we need to know that they're for business purposes. And so, yes, we will pay for conferences. Right now, we haven't figured out how to do airfare, but we're working on it. But there are many costs involved with trying to raise a fund, and a lot of it is travel and conferences and doing LP identification. And there are databases that are very expensive to try and do the top of the funnel, as well as CRMs that are very expensive. So, we're trying to do what we can to help lighten that load.
A strategic question I want to ask is, we fund new startup founders. You fund new venture managers. You and Recast are a new company too. And so oftentimes they'll say, oh, emerging managers are kind of like startups. Would you say Recast is kind of like a startup?
Absolutely.
I mean, yeah.
Yes. I mean, it's been 4 years, and we are taking out the trash and going to the grocery store and, doing all of the FINRA filings and all the audit. And we're doing all the things, right? We've got employees. We have to deal with making sure we dot our I's and cross our T's. So yes, we're very much of a startup.
I don't think sometimes founders or people at startups fully realize how much startup-ishness there is for venture funds and even for limited partners.
Yes, no, absolutely. And it's a lot of the same struggles that you have as an entrepreneur come into play in terms of how do you pivot, how you're thinking, how do you pivot, what your offerings are, how do you pivot, the service providers you're working with. It's painful to try and change a service provider that you already are well embedded with, but sometimes it's the right decision long term for your organization. So, it's once upon a time there was after I had left Weston Presidio and I was figuring out what was next, I had the offer to become a CEO of a number of very early stage companies. And in hindsight, it was they wanted me to help with fundraising. But um, I'll never forget Julie Wainwright, who was the founder of The Real Real. She's from Wisconsin. I'm from Illinois. And back in the day when many decades ago, we were at Bix having cocktails. And I said, should I consider one of these opportunities? And she looked me in the eye and she said, the only time you're an entrepreneur is when there's nothing else you could do. And at the time, I didn't really understand what that meant until I launched Recast. And so at the time that I launched Recast, I could have done that other job, but I really didn't want to do that other job. And so I do think that you reach a point in your career where you know something so well that you have to launch it and you have to own it. And so, that's really why, I'm not a born entrepreneur. And here I am.
Venture has changed immensely in just the past 12 months. Since Recast started in 2020 to now, we've gone through COVID, high valuations, a 2022, 2023 readjustment. Now we're in this period of who knows what's going to happen. I'm curious, from your position as a limited partner, what has the last 4 years taught you, or what's been interesting as the industry's changed?
So the one constant in venture is that it's always changing, right? There's always LPs that say, I've got a denominator effect issue. There's always times in the cycle when the big brand name firms are raising all the money and the emerging managers don't get any attention. And then so there's always been these ebbs and flows. Is what's unique about this part of the cycle. And part of it I did forecast, the other part I didn't, which is there are so many emerging managers, so many. And it was only a matter of time when, as painful as it is, the market would correct. And some, as painful as it is, some people that had dipped their toe into being a venture capitalist maybe decide this isn't the right thing after all. And it's harder than they thought it was. And they may make decisions to go either merge with someone, join a bigger firm, or go back to what their genius is and go back to being an entrepreneur perhaps, or going back to an industry in which they worked previously. And I think, as painful as it is, that's very healthy for the ecosystem. And I think that the firms that do withstand that change in the industry, they're better positioned because there's less competition. And if you can get access to capital, you're better positioned to outperform. So I do think, as painful as it is, that's not a bad part of the ecosystem. The piece I didn't focus on, that I didn't expect, is the bifurcation of the venture industry. You now have firms that are so large and they're raising multi-billion dollars in capital. Some evergreen, they're only investing their own capital, not outside capital. Some, if you add up all the funds that they have, it's multi-billion dollars of investable capital. And I think of that group of managers as being really capable of investing enormous amounts of capital. And there are LPs out there that need to put enormous amounts of capital to work. And they will make that happen. I don't think of those funds as even having the goal of having what I think of as venture capital returns. That safety, and like safety, similar to buyout, if you can consistently do a 2 to 2.5x on a lot of money, you'll raise capital consistently. The other part of the industry is where I think you're going to have the real outsized returns. That's going to be the right-sized funds with the general partners who are scrappy and hungry, not making a lot of wealth off the management fees, needing that carry to really drive outsized returns. So I really see the industry as becoming almost two sub-industries that are very different.
On the bifurcation of venture capital, some of these larger firms are RIAs. They put large checks in. I sometimes joke as a pre-seed fund manager that some of these funds probably don't wake up unless the deal is like 5 million or larger. and whereas we're doing 500K checks. I'm curious, when you all invest in emerging managers, what's the typical either like fund or fund size, or which fund are you coming in? Fund one, fund two?
For our fund of funds, we really want to provide our investors with lots of different forms of diversification, including diversification by fund iteration. So we will have fund ones, fund twos, fund threes, and even some fund fours if we don't see the fund one as having been an institutional fund. People play around with the numbers a little bit. What was your other question?
Is there a certain fund size that you are looking for or not?
So fund size, we believe, is really dictated by your strategy, your portfolio construction, your reserve policy, how many partners you have. So it's not a hard limit on how big the fund can be, but it needs to be very consistent with what you're good at doing and what strategy you're pursuing. That being said, all the funds that we've invested in to date are sub $100 million. And we've invested in a $30 million fund, a $50 million fund. So we are playing in the smaller side of the market, and because they're mostly pursuing a pre-seed and seed stage strategy. We have two managers that are coming in at the Series A, but those funds tend to be more right-sized at 100 or $75 million.
What are some of the biggest challenges emerging managers face? We talked about a little bit, but I'm curious, from your perspective, what are they, and how do you all try to assist them with the ones that you're involved with?
So the barriers to entry to becoming a pre-seed or seed stage manager are very low. Unlike buyout or life science, you can be a really great marketer and enter the industry. You could be really great at public relations, or you could be really great at writing code, or you could be really great at helping people get customers. So there are many different ways and many different backgrounds that you can come into this. The background that is less often is spinning out of an established venture fund. So most emerging managers have never done the process of actually pitching themselves to institutional LPs or to high net worth individuals. And a lot, especially more diverse general partners, sometimes have a hard time bragging about themselves. And yet it's critical. It's critical because you could have the best fund and the best strategy, but if you're the wrong individual to pursue it, it doesn't matter. So you really do need to talk about how, since the day you were born until today, everything you have done has made it so that you can be a great venture capitalist. I'm oversimplifying that, but you get the point. That's the story arc. And then it comes down to some high net worth individuals, some family offices ask inappropriate questions, especially to more diverse emerging managers. And sometimes there's comfort in talking to other people who've gotten these inappropriate questions and trying to figure out what's the right answer if I ever get these questions again. How do I respond in real time? So I think sometimes it's some of those awkward questions, which I had, by the way, some of that I had no idea actually happened, that female venture capitalists get asked their age with great regularity, which made me question what's the right answer. And is what I've determined is the question's the problem. Because men that are young are scrappy and hungry and well networked with the young entrepreneurs. They're going out every night. More seasoned male venture capitalists have great expertise and can add great wisdom to founders and have an incredible network. Women that are younger are looking for a spouse. And women that are more mature are in a lifestyle business. I genuinely think that the problem is the question. And yet people need to know how to answer those questions. Another inappropriate question that I can't believe gets said is a prospective LP will say, "Oh, I've already backed a Black manager this year," or "I've already backed a woman earlier this year." And so sometimes it's helping them to navigate those conversations. And my big answer is, unless you're raising $10 billion, there's a lot of fish in the sea. And you need to figure out who you are, what your strategy is. Do you want to have a partner? Do you not want to have another co-founder? Do you want to do follow-on? Do you want a big portfolio or a more concentrated portfolio? And then you just find your people. Don't try and convince somebody that is not convincible that you are the right GP or that your strategy is the right one and they're wrong. You just hang up the phone, get off the Zoom, get up from the coffee shop, and you find the next person because they're out there, and don't waste time on the people that don't get it.
Fascinating. It's some of the advice that my LPAC gave me, which is have a massive top of funnel.
Yes.
And so we talked about the struggles or challenges emerging venture capital managers face. I'm now curious about what are the struggles that emerging limited partners face, like Recast.
Oh, so it's interesting. Fund of funds. I mean, I've been raising money for fund of funds now for 15 years. Raising a fund of funds, unless you're Greenspring, is and has always been very challenging. And it's because limited partners believe that they're doing it on their own. Sometimes they're not, but they believe that they are, or they are at some scale. In addition, the extra layer of fees gives people, a lot of institutional investors, pause. I will say that one of the reasons why we focused on this part of the market is that it's very hard. No one wants to be a median investor in venture capital funds, and picking the firms that are well positioned to become top decile or top quartile is very hard. And in order to do it properly, we believe you need to be swimming only in this lane. Because if you, not dislike when I was at Weathergage and we talked to every venture capital firm, now just focus on emerging managers, there's a sea of sameness. There was a sea of sameness even with the brand name firms. And if all you do is focus on this part of the market, when something is different, when something is contrarian, it hits you over the head, and you see it immediately. And then you have to spend time and diligence to determine if it's contrarian good or contrarian bad, because they can be very close to one another. But hearing a different way of sourcing, hearing a different way of adding value, a different way of portfolio construction, it's interesting, right? It's interesting. And I continue to hear different approaches than I've ever heard before. And those tend to be the managers where I lean in, spend more time.
What shifts have you seen in LPs in terms of their expectations from fund managers regarding impact and diversity? Do you think that more LPs want exposure to that, or that's less of a concern for them now? Where are we in the cycle?
So there are the LPs that have always cared about these issues, and they continue to care about these issues. Whether or not it's on their website now is to be determined. Whether or not now they are getting out publicly and pounding the table on what they're doing might have changed, but they're still doing this work. For 10 years, I backed white general partners at venture funds, and never once in their deck did they say they were only going to back white entrepreneurs that were men. And yet that's what they did, largely. And so it's there are still institutions today that are asking for reporting on the demographics of the founders that you're backing. There are managers today limited partners today who are looking at the impact that your portfolio companies are having on climate, having whatever their focus is. They are asking for reporting on that in some way. And they continue to do that work. One of the things that happened over the last 2 years, I would say, is that not all, but some family offices and foundations have said, what we're doing on the programmatic side, our investment side of the house should reflect those values. And so if we are on our impact, on our programmatic side, philanthropic side, trying to make the environment cleaner, safer, perhaps we should be investing with venture capital funds that are also pursuing that strategy. And so in the past, you didn't see that as much. And now I do think that that more and more foundations and family offices are having their investment side of the house reflect the values of the programmatic side of their house.
For LPs skeptical about balancing mission-driven investing with financial returns, what's your most compelling case for why diversity and returns go hand in hand?
So, I mean, ultimately, it's going to take seeing the performance. I mean, really, that's what's going to get people who are not believers to change their point of view. In the interim, there's softer things you can do. You can talk about individual companies that have done well. You can talk about more diverse founders that have created incredible large companies with very attractive multiples. You can talk about diverse seed stage managers that have had very high quality follow-on investors. So that's the kind of work you can do in the interim. But ultimately, it's going to come down to, do people who are different than the investors back in the 70s and the 80s, can they drive outperformance? Can their funds knock the ball out of the park? And I firmly believe that that's going to be the case. It just takes a minute in venture and early stage investing. It takes time, but I firmly believe that will happen. One of the for our fiscally sponsored nonprofit, in order to make it a nonprofit, we are going to be tracking all 90 funds, and we will have a publicly facing report that Milken's going to do for us that is going to either prove or disprove the hypothesis that more diverse general partners end up investing with more diverse founding teams. We believe that to be the case, but there has not been any quantitative data that's ever been presented. So
I think that's the case from our own experience of veterans investing in veterans, and also with other diverse managers. We find, I think it'll find that to be the case. What qualities do you all look for in emerging managers in terms of the emerging managers you all select?
So we think of it as really three different archetypes. We have the archetype that is just a spin out, blue chip spin out from, but then there's a lot of, and we've made some very successful investments at my last firm with this type of archetype, which is rock star operator, attractive angel track record and portfolio, unrealized, but we'll sink our teeth into it, do the heavy lifting on whether or not we like that, and now raising their first institutional fund or their second institutional fund. And then the third archetype is just more established emerging managers. I'm not saying that a fund 2 is always established, but in some case, the fund 1 could already be really rocking and rolling. And so it is de-risked to some degree. So those are our three archetypes that we've identified that we'll invest in, and we have invested in all three archetypes. And then within that portfolio, we are looking for diversification by vintage year, by fund iteration, underlying industries. We would, in a perfect world, not want to have any of our GPs investing in the same companies, because we want to be able to have more diversification in terms of the portfolio construction.
I've often heard from mentors that fund 1, you're pitching paper returns. Fund 2, you're pitching, or you're pitching a vision. Fund 2, you're pitching paper returns. And Fund 3, you're pitching real money back. Do you think that's a good analogy?
I do think it's a good analogy. I mean, the only issue is you have to take the macro environment over that. And, sometimes liquidity is hard. Sometimes getting quality follow-on investors is hard. And so, what actually happens in each of those stages might change. It might be that you prove that the company has real revenue, or you prove. I mean, I remember back when the economy hit a tailspin with Lehman going under and the public markets collapsed. It was very hard to get liquidity for venture companies. And a lot of LPs said, these are paper returns, and is there actually value in this portfolio? We went out to our early stage venture managers, they're mostly brand name venture funds, and we asked them, how many companies do you have in your portfolio that are over $100 million in revenue? And it was staggering. So one of the things that happens in the private markets, even if you're an early stage investor, if there's not liquidity, these companies keep growing, assuming they've got a good value proposition. They keep growing. There's just no way to get out. But there's value that's been created. even though there's no liquidity. So I agree with the three archetypes, but sometimes what you have to prove shifts a bit.
What advice do you have for emerging managers who are thinking about the times between fundraising, so deployment cycles? Do you think it, like in 2020, 2021, it was like, oh, 2.5 years is probably right. Now I've heard that funds are delaying or slowing down their deployment. What advice do you have?
So it used to be that it was every 3 years. And then when things are frothy, many managers go to a 2-year cycle. Fund of funds, by the way, have to emulate what the cycle is of managers, because you don't want to have, if you've got a great manager that is your first commitment, you don't necessarily want a large percentage of your portfolio you don't want to re-up with that same manager in the same vehicle. So it tends to be 2 to 3 years. And there always are managers out there that when things are frothy, they go, I'm slowing down because I'm not paying those valuations. I'm not getting into these party rounds. And so there's always the GPs who are not participating in that, but usually it's 2 to 3 years. And I think it ebbs and flows depending on, access to capital. But I do think that now, to the extent that people can, they are elongating the amount of time that they can deploy their capital, because the fundraising market is more challenging. And so maybe I give myself a little bit more runway before I'm back in the market again.
That makes sense. Can we talk more about your tuition-free education, which is a second pillar?
Sure. So the tuition-free educational program is what we started with originally back in 2020. So we were on Zoom to be as inclusive as possible. COVID, it just made it even a better decision. But we want to bring together LPs and GPs virtually so we can have a bigger conversation. And so we, through that program, learned a lot. The community really valued having a safe space to ask what sometimes it feels like a not smart question, but everyone has them. Also creating space for the community to get to know one another. We find the emerging manager community, especially the diverse emerging manager community, is so collaborative, and 1+1 = 3, really helping lift up each other, and creating the space for that was valuable. We also have been providing 6 sessions of executive coaching for free, and that has been the community really values that. It's lonely being a emerging manager. Many of these managers are solo GPs, and many of these managers, their personal life and their professional life bleed together 24/7, and so trying to create boundaries, trying to create balance. And so the executive coaching has been very valuable. And then what's happened is the fiscally sponsored nonprofit has taken all that and then layered another $100,000 of covering operating expenses on top of it. So Accelerate is sort of the next generation of what we've been doing on the enablement side of the house.
Fascinating. Maybe this is a good analogy, but for your funnel, it feels like it's the tuition-free education top of funnel. Mid funnel is the accelerator / the nonprofit that provides 100K, and then bottom of funnel might be your fund of funds. Is that a good read or not?
So we think of them almost more on a horizontal as opposed to on top of one another. So we are, through our fund of funds, we're not just sourcing opportunities through Accelerate and enablement. Although we are certainly open to that, and we've identified a number of managers that we would like to have in our portfolio. But we're more than happy to be investing in folks that have never gone through our programs. And in fact, a number of our commitments to date have never come through any of our programs.
Understood. And so how do I apply, or how do I potentially join either enablement or accelerate? Go to your website.
So go to our website, sign up for our newsletter, follow us on LinkedIn. We normally will announce that first on LinkedIn. We try and get it in our newsletter, but LinkedIn we always do it on. Also you can reach out on info@recastcapital.com. We do maintain an Airtable database, and so we'll try and send out a blast email as well. But we don't need a warm introduction. That is part of what we believe is important for this community. So happy anyone who thinks they could benefit from what we have to offer. We would welcome you reaching out.
Amazing. And for the enablement, are there certain times of the year? Do you do this once a year, twice a year?
So we did do enablement twice a year. Right now, we're only doing Accelerate. We're not doing enablement programming right now. We're doing these Accelerate cohorts once a year, and we'll be doing our next Accelerate cohort, our last Accelerate cohort for the pivotal capital that we have. Will be, I think we've said it's going to be right before summer of 2025. So applications should be open in Q1 of next year.
Got it. And so Lenore Carafa, who's a teammate, had mentioned she had gone to some really nice event with you all in Sonoma. Was this part of Accelerate?
So we actually do that as part of enablement. I know it's
Okay.
very confusing.
No.
So we did our first inaugural summit last year up in Sonoma, and we opened that up to our, entire the emerging manager community at large, as well as LPs who are interested in that community. And we will be doing another summit. We intend to make that an annual affair.
Wow.
Whether or not it's in Sonoma is to be determined, but we are talking about doing our next summit. And it is not dissimilar to our what we were doing with our enablement program. The goals are, again, to try and create safe space for these emerging managers to really get to know each other, trust one another, be confidants with one another. And then we also create space later for LPs to engage in the conversation. But we do want some sacred space with just the GPs. And we try and make it an unconference. We don't want a bunch of people talking to you. We really want you to be engaged and involved in all aspects of the conference. So it was very well received. I'm glad that she enjoyed it.
It was well received online. All my peers were posting about it. So congrats to everything you all have done for the ecosystem and that you all will be doing. If there's limited partners listening to this podcast, why should they be investing in Recast?
So Recast is just a way for you to get diversified, thoughtful exposure to emerging managers in venture. And so if someone's interested in learning more about that, I'm happy to have those conversations.
Awesome. I'm going to wrap this up with some rapid fire questions. What are some of your favorite books?
Oh gosh, do I have time to read?
They can be high school books, maybe like Great Gatsby or...
Yeah, no, nothing is coming to mind right now.
How about any favorite movies? You probably don't have time for movies.
No, I do have time for movies. I'm looking forward to seeing Wicked, which I can be seeing in a couple weeks. Also have I'm sorry, I'm drawing blanks on both of these.
All good. These are rapid fire questions. Some of your favorite places to travel to?
Yes. So if I lived in Western Europe, I would go to Africa every year. I just love the African people, the pacing. It relaxes me. I run pretty type A, and to take that down a notch in such a beautiful place. So I love Africa. Just took my family for the first time to London over the Thanksgiving break. That was great, although I would have loved Spain or Greece because I haven't been to those two countries, and I've been to London many times. But love traveling, and one of the challenges with living in San Francisco is you're far away from everything.
Indeed. What are some of your favorite songs or musicians?
So my 10-year-old daughter has gotten me into Taylor Swift. So I respect that she is such a great role model for young girls. She also her songs are very female empowerment, very good messages for young girls.
Amazing. Courtney, wishing you and Sarah tremendous success at Recast. Thank you for all that you've done for the diverse emerging manager ecosystem, all that you will be doing. Wishing you all tremendous success with your fund of funds, with enablement, with Accelerate. Thank you for taking the time to chat with us today.
Thank you for having me. Really appreciate it.